If you're 60 or older and your super is still sitting in accumulation, there's a better than even chance you're paying somewhere between $5,000 and $90,000 more in tax than you legally need to. Not over your lifetime, per decade, sometimes more. The number depends on your balance, how your fund's invested, and how long you wait to do something about it. But the direction doesn't change. The tax is real, it's substantial, and for most people watching this, it's completely optional. My name's Steve Kaldor Cott. I spent 38 years in private tax and superannuation practice before I retired in 2022. Sole practitioners, small partnerships, eventually my own firm. Thousands of personal returns, hundreds of SMSFs, more ATO correspondence than I care to remember. The work was detailed, often repetitive, occasionally frustrating, and consistently revealed the same pattern. The Australians who understood how super worked past 60 paid dramatically less tax over their retirement than the ones who didn't. Not because they had more money to start with, because someone sat them down at the right time and explained what changed when they turned 60, what became possible, and what they needed to do before certain windows closed. This channel exists because that conversation still isn't happening for most people. The system is complicated by design, the rules change regularly, and the advice industry is structured in a way that tends to serve the people who already know what questions to ask. Today, I'm walking through the single biggest structural shift that happens to your super at 60, why it matters more than almost anything else you'll do with your retirement savings, and the 7 specific legislated reasons to act on it now rather than wait. Not all 7 will apply to your situation. At least 3 of them apply to more people than realize it. And one of them, if you're in a couple approaching pension age, has a countdown attached to it that doesn't pause just because you haven't sorted it out yet. Let's start with the one almost nobody explains properly. From the day you turn 60, super income stream payments from a taxed source arrive in your hands completely tax-free, not reduced by an offset, not assessed at a lower rate, zero. The ATO does not take another cut. Whether you draw it as a regular pension payment or a lump sum withdrawal, once you're 60 and you've met a condition of release, the tax rate on money coming out of your super is nil. Your contributions went in at 15%. From 60, they come out at none. The reason this gets missed is partly how super is discussed publicly. Almost all the attention goes to what goes in. Contribution caps, employer SG rates, salary sacrifice strategies, carry forward provisions. What comes out and what the tax looks like on the way out gets a fraction of that attention. The practical consequence, and I saw this hundreds of times over the years, is people in their early 60 seconds drawing income from outside investment accounts, selling down assets, pulling from savings, all of which carry their own tax implications while leaving a completely tax-free income source sitting untouched inside their super fund. Still consulting 2 days a week. $400,000 in super earning 6%, drawing nothing from it. That balance is generating maybe $24,000 a year in earnings, taxed at 15% inside the fund. Meanwhile, they're selling shares to cover living expenses, triggering capital gains, paying tax at their marginal rate. A modest tax-free income stream from super would have covered most of what they needed without touching a dollar of taxable outside assets. The option was there. They just hadn't been told it existed. Whether that's the right move for you depends on your total income picture, what else you're earning, whether you're still working, what offsets or concessions you're currently claiming. The principle is simple. The implementation belongs in a proper license conversation. But the question worth putting to a financial advisor is this. If I start a super income stream now, at my current balance and drawdown rate, would it be fully tax-free in my hands, given my other income? And would it affect any offsets or concessions I'm currently entitled to? That question has a real answer. Most people have never asked it. Underneath the tax-free payments is something even more substantial. And this is the one that surprises people most when they hear it clearly for the first time. In accumulation phase, the investment earnings inside your super fund are taxed at 15% every year. Interest, dividends, rent, capital gains, the fund's total assessable income, 15%. Once your super moves into retirement phase, an account-based pension, those same earnings attract 0% tax, not 15%. Zero. Up to the transfer balance cap, which is $2.1 million from 1 July 2026. Before you take that and run with it, there's a distinction here that matters and gets blurred constantly in online discussions. If you're still working and you start a transition to retirement income stream from 60, which you can do without ceasing employment, your payments arrive tax-free in your hands. Good. But the earnings on the assets inside that TTR account are still taxed at 15%, same as accumulation. The 0% earnings rate only applies in genuine retirement phase, which means a full account based pension, which means you've met a condition of release. The most common one at 60 is ceasing an employment arrangement, not permanently retiring from all work forever. Ceasing a specific employment arrangement after you turn 60 is enough. The benefits accumulated to that point move into retirement phase. New contributions after any subsequent re-employment are represerved until a fresh condition is met. The difference between 15% and zero compounding over years is not trivial. On a $500,000 balance earning 7% annually, the earnings tax in accumulation runs to roughly $5,250 per year. That's simplified, the actual figure depends on asset mix, how much of the return is franked dividends versus interest versus capital gains, and factors specific to your fund, but the direction doesn't change. In retirement phase, that $5,250 stays in your account every year, compounding. Over 15 years, we're talking about a six-figure difference in your final balance, and that's before you factor in what you're drawing to live on. After close to 4 decades watching how these accounts performed over time, the ones left in accumulation past 60 almost always had the same explanation. Nobody had sat down and modeled the alternative. For people still working at 60, there's a version of this that doesn't require you to have retired at all. At preservation age, you can start a transition to retirement income stream and draw from it within a band of 4% to 10% of the account balance each year, with those payments arriving tax-free in your hands. Simultaneously, you redirect salary into super through salary sacrifice. Your employer's super guarantee is already 12% of your ordinary time earnings for 2025 to 26. The concessional contributions cap, before tax contributions including employer SG and salary sacrifice combined, is $30,000 in total. On a $90,000 salary, the employer's 12% is $10,800, leaving just under $19,000 of the cap available for salary sacrifice. That $19,000 goes into super at 15% tax instead of your marginal rate, which is 32.5% or higher for most people at that income level. The reduction in take-home pay from salary sacrificing that amount can be roughly replaced by drawing tax-free income from the TTR, net result, more accumulating in super, roughly the same cash flow in your pocket. The honest version is that TTR earnings are still taxed at 15%, not zero. This strategy works best for people on higher marginal rates with a meaningful super balance and a few years still in the workforce. For someone on a modest salary with a small balance, the administration and setup costs may not justify the net gain. That's not a reason to dismiss it. It's a reason to have the specific numbers run before you set it up. The fourth reason is different in kind from the first three and deliberately short. Retirement doesn't arrive at a single age. The early phase, roughly the 60 seconds, is where you still have the physical capacity to do the things you spent 4 decades saying you'd do when you had time. Travel that involves actually moving. A new interest that requires learning it, not reading about it. Time with people who won't be around indefinitely. Your super was accumulated to fund your retirement. Using it at 60 for what 60 makes possible is exactly what it was built for. Waiting until you have to use it is not caution. In a lot of cases, it's just delay. The most consistent thing I heard from clients in their late 60 seconds and early 70 seconds was not regret about spending too much in early retirement. The regret ran the other way. That said, whether drawing from super at 60 makes sense depends on your balance, your longevity picture, and whether you have a partner whose financial security sits inside the same pool of money. The values case is real. The numbers still need to work. That's the broad case: tax, earnings, structure, and time. Now, here are 3 reasons that are less obvious, and for some people watching this, considerably more consequential. When you die, your super doesn't automatically pass to your adult children tax-free. This is the thing almost nobody explains at the right time, which means most people find out about it after it's too late to do much about it. Australia abolished inheritance tax and death duties in 1979. There is no inheritance tax in this country, but super paid to a non-dependent adult child, a child over 18 who isn't financially dependent on you, is different. The taxable component of that super, which is the portion built from employer contributions and most before-tax contributions accumulated over your working life, attracts tax in the hands of your adult child at around 17% effective. That's 15% plus the Medicare levy. On a $600,000 balance that is 90% taxable component, that's roughly $91,000 Your children pay for the privilege of receiving your retirement savings. The money exists. It accumulated over 40 years. It just went somewhere other than where you intended. Here's what changes that. Once you've met a condition of release at 60, you can withdraw from your super as a lump sum. That withdrawal is tax-free in your hands from a tax source. You then recontribute the same amount as a non-concessional contribution after tax money going back into the fund. That recontributed amount becomes tax-free component. Run this systematically, and you convert your super's taxable component into tax-free component over time. When you die, the tax-free component passes to your adult children without the 17% hit. The bring forward rule allows up to $360,000 in a single year if your total super balance was below $1.76 million at 30 June prior. On $360,000 converted from taxable to tax-free, you've eliminated approximately $61,200 in death benefits tax on that portion alone. The ATO's position is not ambiguous. The relevant case, Pett versus Commissioner of Taxation, 2017 AAT A1270, confirmed that a recontribution strategy for the purpose of reducing death benefits tax on super paid to non-dependents is a legitimate series of transactions and does not attract Part 1 VA, the anti-avoidance provisions of the Income Tax Assessment Act. This is not a loophole. It is the legislation operating as written. The window runs until 75. Non-concessional contributions close at 75. You have from 60 to 75 to run this systematically. Starting at 61 gives you 15 years. Starting at 70 gives you 5. The Australians who know about this run it. The ones who don't find out about it at 76, or find out when the estate is being wound up, and watch a meaningful portion of what they worked 40 years to accumulate go somewhere other than their children. Same legislation, same provision, available to anyone, different conversations with different advisors at different points along the way. What you need first is the percentage of your current super balance that is taxable component. Your fund will tell you. Most people have never asked. Once you have that number, the question for a licensed financial advisor is this. Given my current taxable component, what would the death benefits tax look like on my balance if paid to a non-dependent adult child today? And can we run a recontribution schedule over the years I have left under the NCC cap to reduce that? Specific question, specific answer. Take it in with the number. The sixth reason most couples have never considered has been sitting in the rules the whole time. Super held in accumulation phase by someone who hasn't yet reached age pension age, 67, is not assessed by Centrelink under either the assets test or the income test. Not reduced, not deemed, invisible. The moment that super moves into pension phase, account-based pension or TTR, the full balance is immediately assessed as a financial asset regardless of age. And once you cross 67, all of your super in any phase is assessed. For a couple where the older partner is approaching 67 and the younger partner is in their early 60s, those years between represent a finite planning window. The younger partner's accumulation super doesn't exist as far as Centrelink is concerned. Outside super assets, bank accounts, shares, managed funds absolutely do, which means there can be a genuine structural case for moving accessible outside super assets into the younger partner's accumulation before the older partner's 67th birthday and the age pension application that follows. Contributions into the younger partner's super reduce the assets sitting in plain sight. For some couples, the difference in ongoing age pension entitlement is not marginal. The trap is the obvious one. If the younger partner starts a pension from that accumulation, even a TTR, before reaching 67, the exemption disappears immediately. The accumulation balance is the shield. Starting the income stream is the moment the shield goes. Sequencing matters here, which is why having this conversation 5 years before the older partner's 67th birthday consistently produces better outcomes than 3 months before. The question's worth putting to both a licensed financial advisor and a Free Services Australia Financial Information Service appointment. The FIS service is free, and the officers will walk through exactly how Centrelink currently assesses your structure. What does our combined asset and super picture look like through Centrelink's lens right now? And what would we need to do, and by when, to be in the best position before that 67th birthday? The window closes on a fixed date. Whether you've used it well is a different question. The seventh reason is the most recent. On 13 March 2026, the Building a Stronger and Fairer Super System Act received royal assent. Division 296 is law. From 1 July this year, individuals whose total super balance exceeds $3 million face an additional 15% tax on earnings attributable to the portion above $3 million and 25% on the portion above $10 million. First assessments land after 30 June 2027. The tax applies to realized earnings, dividends, interest, rents, realized capital gains. The original proposal to tax unrealized gains was removed from the final legislation before it passed. That removal changed the character of the problem substantially, particularly for SMSFs holding illiquid assets. Why this belongs here is straightforward. The retirement phase account-based pension, with 0% earnings tax, continues to apply on amounts within the transfer balance cap, which is $2.1 million from 1 July this year. For a 60-year-old with $1.5 million in super today, investing over another 2 decades at a reasonable rate of return, the trajectory toward $3 million is not implausible. How the balance is structured, how much sits in retirement phase within the cap, how much remains in accumulation above it, has a different answer now than it did before this legislation passed. The couple's angle is worth noting directly. Division 296 applies to individuals. 2 partners can each hold up to $3 million, $6 million combined, before either is affected. A couple sitting on $4 million combined, with a heavily imbalanced split between accounts, has a structurally different problem from a couple holding the same total with accounts closer to even. The period around 60, when contributions can still be made and accounts can still be rebalanced within the applicable caps, is precisely when this is worth examining. The honest version is this. If your balance is $700,000 and you're 60, Division 296 is not this week's priority. But if you're mid-7 figures and haven't reviewed your superstructure since this legislation received royal assent, that review belongs on the calendar. New legislation creates planning opportunities for the people who move quickly and quiet compliance problems for the people who assume it doesn't apply to them until it does. Every one of those 7 traces back to the same gap. The rules that govern your super shifted when you turned 60. The tax on your income changed. The tax on your fund's earnings can go to 0. The planning options opened. The window towards 67 started running. For most Australians, the account just sits in accumulation anyway, earning a reasonable return, paying 15% on its earnings, doing none of the things the legislation now allows, not because the rules aren't there, because nobody sat down and explained that they were. Which one applies to you depends on where you are right now. Still working? Start with the third. Already retired and drawing nothing from super? The second is the first conversation, thinking about what your adult children actually inherit. The fifth, and the sooner the better, given the window, in a couple with the older partner approaching 67. The sixth, and the clock on that one is real. 3 things before you close this. First, find out your taxable component percentage. Call your fund or log into the portal and ask that specific question. Most people have never looked at that number. It's the starting point for at least 3 of the 7 reasons covered today. Second, if you're in a couple and the older partner is within 5 years of 67, book a free financial information service appointment through Services Australia before that birthday arrives, not after. The question to bring is how Centrelink currently assesses your combined structure and what it looks like before an age pension application. That appointment costs nothing. It is a free service. Third, for anything structural, take what you've heard today as your agenda into a session with a licensed financial advisor. These are the right questions. Walking in knowing them already matters. One more thing before you go. I'm a retired accountant with close to 40 years in this area, but I'm not a registered tax agent or licensed financial advisor, and what I've covered is general information. Your specific situation belongs with a licensed financial advisor, or for the Centrelink and age pension questions, one of those free FIS appointments. That's it for today. Take care.